Okay, this is a question to practice on this topic for discounted payback period, and these are the cash flows from year 0 to year 3. And to get the discounted payback period, you first need to discount all the cash flows, and the discount rate here is given as 10%. That is your cost of capital. So you're going to discount each of the cash flow with 1.1, which is 1 plus 10%, reduced to the power of whatever year number. Okay, so 950 would give you 950 because it's happening today, but for the others you have to discount them. Okay, and then you try to get the cumulated discounted cash flow. Okay, cumulative discounted cash flow. So you start with this balance. Okay, and the next year your balance will be the money made in the first year, okay, plus any balance of last year, okay, and then just simply drag it all the way, okay, and you can see that my balance turned out to be positive after the second year. So my discounted payback is this. So it is 2 plus the fractional part of the payback is 72 divided by 334. So it is the absolute value of 72. So just say ABS. Okay, 72 divided by 334. So that's 2.22. Okay, 2.22 years. Alright, so that's a practice for discounted payback. And then the next subject is a modified IRR, modified internal rate of return. It is basically the IRR with some adjustment. If you use a calculator or a piece of paper to do the job, that's going to be much tougher. But if you use Excel, that's going to be a very easy operation. So what is the modified IRR? So let's say this is your cash flow, negative 100 investment upfront, and you make a $10, $60, $80 for the next 3 years. Okay, so what do you do with the money when you make them? Okay, if you have a $10 just made in the next year, what do you do with it? You don't spend it right away. You're probably gonna save it and save it to the end of the project. Okay, so what is your saving rate? The saving rate is more reasonable at a 10% level, okay, and this 10% is just your cost of capital. That's the market rate for borrowing money and to lend money, and when you're saving money, basically you are lending money. So if you save money, you make 10% rate, just like you borrow money, you pay 10%. Okay, so that's a very reasonable assumption. You save $10 for 2 years, and you save $60 for 1 year, and when you get $80, you just put in there in your account. You earn no interest for this $80. And then you get this ending balance, okay, 60 times 1 plus 10% is 62, 66, and 10 times 1 plus 10% to the second, you get a 12.1. So you add all the cash together, you get a 158.1, and that's your future value or the terminal value. So that's how much you get after 3 years of sweating work, okay. That's how much balance you have. And then this is your initial investment, negative 100, and the difference between, so the relationship between 158 and the negative 100 is a discount rate of 16.5%. Okay, you discount this ending value for 3 years at 16.5% to get this $100. Okay, so the 16.5% is your modified IRR. Okay, that is what it takes to get a 0 NPV. So how do you get a 0 NPV? Your NPV is going to be negative 100 plus 158.1 divided by 1 plus this modified IRR, which is just 100, so your NPV would be 0. Okay, so that's the modified IRR, how we interpret the process. Right here is your regular IRR. Let's say why we need to modify this, why we say the regular IRR has pitfall. Okay, so the regular IRR here, based on this cash flows, negative 100, 10, 60, and 80, you would suffer IRR rate of 18.13%. And in this framework, you basically are assuming that when you deposit money, you would make 18.13%. Okay, that's a very large rate for your investment return. Okay, no financial institutions would give you 18.13%. Okay, if you deposit that money. So that's why this regular IRR is not as good as modified IRR. Okay, but if you stay with what we just did with the IRR, you deposited $10 for 2 years, you deposited $60 for 1 year with 18.13% rate, and you got a final terminal value, so that's your final balance. And if you use the IRR as discount rate for the final balance, it would give you 100. So how much did you invest today? You invest a negative 100. So if you use the IRR as the rate, and this as the future value, and this as the today's cash flow, so negative 100 plus the discounted future value, which is 100 positive, you will get 0. So your NPV will get 0, and the discount rate when you have a 0 NPV is IRR. Okay, so that's the basic framework of IRR. As I said, this is unreasonable. When you have 18.13% for reinvestment rate, that's not quite possible. That's why we need to modify this IRR. So the more reasonable reinvestment rate would be 10%. It just be the same as your cost of capital. All right. So since this is a take-home exam, I'm not going to show you how to do it on paper. Instead, I just use one line of Excel to do the job. Okay. So your cash flow here is negative 100, 10, 60, and 80 for that project. To get the IRR, this is super easy. Okay, so the IRR will be just covering these cash flows, so it's 18.13%. Okay, if you want to get the this modified IRR, all right, then you need to use IRR formula of Excel, and then still you have to select all the cash flows. Okay, and the finance rate is your cost of capital. You can put it as 10%, and a reinvestment rate, that's the key part to distinguish this modified against the regular. The reinvestment rate, you should also put at 10%. Okay, and then you hit enter. That's your modified IRR. Alright, so I have spent a lot of time to explain why you need to modify the IRR, and but to get it done in Excel, that's very easy to do.